So today we'll look at we'll continue from where we stopped. We'll look at time frame. Then we'll look at market movement. We'll look at market movement. Then we'll now begin to talk about technical analysis. You send the link. Thank you, sir. Share the link on our group too. I think you are the only one that can send message on that group. Sir? I tried to send a message on the group one time. It didn't go. So, just like I said, we will be looking at... Do you need pen, sir? Okay. So, we'll just go straight... We'll just go straight to the point. Now, to trade in the financial markets, I have to stay in one place, Abby. Okay. So, to trade in the financial market, you actually need a broker. You need a broker because it is the broker that will give you the platform. So the broker gives us the platform to participate in the trading activity. So it's not something you can do all by yourself. However, it's now very easy now because everything has been digitalized. I want to make sure nobody is missing out. So, Gospel, if you can put on the screen, or you are working, right? If you can put on the screen a chat or something. But that doesn't disturb your work. You can continue with your work. Or will it disturb your work? It will disturb. Okay, whenever I need it, I'll ask you to put it on. But you can do YouTube for me. Put chat. All right. Okay, so we need a broker. And the broker helps us. They give us the platform to. It gives us the platform to be able to participate in trading. So the broker, a verified broker, because there are brokers that are not verified and they are in the market. So the implication of that is if you deposit your money, when you are losing money, they won't say anything. It's when you make money, big money, then withdrawal will now become a problem. So they will start telling you all kinds of stories. So you won't be able to have your withdrawal. However, when you are losing, no problem. It's when you now start making money that there will be problem. So if you want to know whether a broker is verified, once you go to their website, you go through the website, you will see some common and major registration countries where they've gotten their license. Some of them, you don't need this, but I could just mention SCA, FSCA, which one again? These are the common one. So you see the major brokers, you see them having some of these licenses. Some also go as far as getting 3 or more, just to be more legitimate and more solid. Okay, so we don't need all of this, but I just need to let us know that in trading, it's not that you take your money to the bank or you start looking for a brokerage firm, house. You know, when you want to buy shares, I think that one has even been digitalized. You can actually do it on your phone now. Yes, if you want to buy shares, the company that you want them to brokerage you download their app, and from there you'll be buying the shares right there. Unlike before, where you have to go to their company, then they will give you what is this called, that certificate, share certificate. So that era is gone. Yeah, it's gone. Okay, so now, yesterday I was talking about market session. Yes, and I mentioned that there are 3 major ones. We have Sydney, we have Tokyo, we have London and New York. But the 3 major is Asian, London and New York. The Tokyo and Sydney, the Sydney and Tokyo has been compressed together to be Asia. And it starts from 11 p.m. Sydney opening, 11 p.m. Then Tokyo opening. The 2 of them together hence around 7 a.m. in the morning. Then by 8 a.m., London session open, Nigerian time, West African time. 8 a.m. in the morning, London session open. And then by 2 p.m., 2:30 p.m., depending on their climate, they have this time changing. So sometimes this 1 hour difference will make it become 1:30. Sometimes it is 2:30. So I think right now it has fallen back to 2:30. New York session, right? Okay, so New York session, and we said the most volatile session is that New York opening. Why? Because London session and New York are overlapping together, and during that period there are more investors in the market, more participants, so it increases market volatility and momentum. And this is where most people like to trade, because there are a lot of movement in the markets that gives opportunity to trade. So relatively, the Asian session is quiet. The market ranges during that period. Then we also have what we call the time frame. If you look at this chart now, you will see something like this: 1M, 5M, 15, 30, 1, 2, 4H, DW month. These are the major ones people use. All right, you can actually customize it yourself. You can decide to use 4 minutes, 2 minutes, 4 hours, 8 hours. There was a time I was under one mentorship, and he uses 8 hours. He uses 2 minutes, 8 hours. So I wanted to start using it, but I couldn't sustain it. So I just went back to the traditional one. And these are the traditional one that everybody knows. So now, what's the significance of the time frame? What's the significance? What is the role the time frame plays in the market? Now, for the M means monthly. D means daily. The H there, that's hour, 1 hour, 2 hours, 4 hours. Okay, this person even has 2 hours. 2 hours is not the traditional one. It's 1 hour, 4 hours, 30 minutes, then 15 minutes, 5 minutes, 1 minute. So now, the time frame that you click, that you are on, shows you what the market is doing per that time frame. So let's say, for example, we are on 15 minutes right now. It's telling us what the market is actually doing every 15 minutes. There's what we call price action in the market. Price action is actually referring to the movement of price. What is the price saying? Is the price increasing or decreasing? So the time frame you are using at that moment is telling you what the price action is doing at that interval. Every 15 minutes, what is going on in the market? So if you go to monthly, you will also see the monthly time frame that is showing us what the market is doing every month. Yes. One of the things we also talk about here is the different types of trading analysis. So now, going back to the time frame, before that, let me quickly talk about this. Yes, there are different types of trading style, trading analysis. We have scalping. We have intraday trading. Intraday or daily trading. We have swing trading. The reason why I quickly jump on this is it will make us understand time frame properly. Yes, then we have position trading. Now, scalping. This is a style of trading scalping is a type of trading where traders look for a very short-term trading opportunity, a very short price movement, very short price movement, short trading opportunity that can be concluded within short hours, short time. Price movement within a short period. Do we understand that explanation? So, scalpers, those who scalp, those who use this trading style, they call them scalpers. Yes. I can't deny that I am one. So scalpers. So scalpers are people who are looking for short movements in the market within a short time. They are looking for trading opportunity within a short time in the market. So they go in, they are out.
What within time frame of like 15 minutes?
Exactly. You know, as I'm explaining this concept now, you now understand the time frame thing there. Exactly. So they go in and out. And this style can make you go into the market as many times as you want within the day. As you want. Why? Because you are using a shorter time frame to analyze the market. And then you are going in, you are coming out. Going in and coming out within a short period. And you can decide to just do it once in a day and then you are done. And you can decide to keep going and coming, going and coming, going and coming as much as you want. That's scalping. Now, intraday trading. These are people who are looking for trading opportunity within the day. Within a day. Within a day. So it could be within 4 hours. It could be within 6 hours. It could be within 8 hours. So they look for trading opportunities within a day. They execute their trade and conclude that trade within that day. We call them intraday trading traders. So intraday trading, day trading is for traders who look for trading opportunity within a day. So they are called day traders. Then we have swing trading, swing traders. These are people who look for trading opportunity within 2 or more days, 2, 3, 4 days. So they look for a more longer opportunities, more than the day trader. So theirs could take, they are looking for trading that could go into 2 days, 3 days. They hold positions for 2, 3, 4 days. Then we have the position traders. The position trading. These are big investors who look for trading opportunities for months, weeks, months. So now, going back to time frame. Going back to our time frame, you will see that if you are going to be a position trader, Can you give me the time frame, the one we had before? Was it from the laptop? Okay, give me that one. I love that one. So if you are going to be a scalper, there is nothing you are looking for in the monthly time frame. You can't go and be doing analysis on a monthly time frame. You won't get anything. Why? Because I want to show us something. Each of those candlesticks you see on the chart, these are candlesticks. These green, red things you are seeing, they call them candlesticks. Now, each of these candlesticks you see, this is 15-minute time frame. Each one of them takes 15 minutes to form. Yes, each of them. So what we are seeing is price activity within 15 minutes being reflected in these candlesticks. Do we get it now? Go to monthly. Oh, okay, we can't go to monthly. It's not our property.
It is monthly.
That's it. It might be bigger. No, it might be bigger. It might be small, depending on. Because what has happened is that we have compressed how many. Okay, let's take it like this. We have 1 minute. Each candlestick takes 1 minute to form. If you now go to 5 minutes, they have compressed 5 1-minute candlestick into one. Then, when you go to 15 minutes, we have compressed of 1 minute. Of 1 minute. Please, can you give me your original chart so that we can quickly for 5 minutes? Because it too is doing something else. So, I will just show it. 1 minute. Yeah, 1 minute. Yes, if it's on 1 minute time frame, each one forms within a minute. After a minute, another one will start forming. And this tells us what is going on in the market. Are the buyers in control? Are the sellers in control? We will get there. So but let's take it bit by bit. Okay, now, good. This is our chart. Go to 1 minute. Now, if you look at this chart now, look at this last candlestick. You see, it's forming a red candlestick, and it's going to end in the next 15 seconds. After that, a new candlestick will start forming. Are you getting it now? Look at it. In the next 4 minutes, a new candlestick will form. It will start forming. This one has ended. And from there, traders are beginning to interpret what is going on. Okay, are sellers in control? Are buyers in control? We will get there to know when sellers are in control, when buyers are in control. Now, if you go to 5 minutes, don't forget each of these candlestick, this 1 minute candlestick. If you go to 5 minutes, those 5 candlesticks is one here, because each of these candlestick on 5 minutes took 5 minutes to form. That is time frame. That's why we are here on time frame. When you are on 15 minutes, each of the candlestick is taking 15 minutes to form. That means there are 3 5 minutes inside 1 15 minutes. Then when we go to 30 minutes, go to 30 minutes charts. Each of these candlesticks formed in 30 minutes. So there are 2 15-minute candlesticks in each. We have currencies, commodities, crypto, stock, and indices. Now, this is gold. Gold is under commodity. Now, look at this is gold charts right now. But you will notice something. I want you to observe what you are noting, what you notice on the screen. Now, go to monthly. Look at the entire chart pattern, the charts, everything together. Now, this is 1 month on gold. Go to daily. Same gold. Do they look alike? So what do you notice? Give me another one. Give me 5 minutes. Now, go back to that daily. Same gold. Look at the chart. Look at the entire chart. Look at the structure, the entire pattern. All right? Now, go back to 5 minutes. Do they look alike? The same gold, but is the chart looking alike? How? I'm not talking about candlestick just alone now. I'm talking about the entire chart. Go back again to daily. Look at the entire pattern. This is gold on daily. Go back to 5 minutes. Do they look alike? They don't look alike. If you go to that daily, go back to daily again. If you go to that daily, see what you are seeing. See what you are seeing. Let me draw it here. You are seeing it going up. But if you go to 5 minutes, it's like it doesn't have direction. It went down, it came up again like this. It's not looking the same. But it's the same gold. Different time frame, now giving us different view and perception. You know, I was answering the question. I was telling us something yesterday. I said, when you are buying, somebody is selling. Despite the fact that both of you learned the same thing. He is seeing a buying opportunity. You are seeing a sell opportunity. And both of you may not be wrong. This is one of the factors. Because when you go to some time frame, the chart will be telling you it is time to sell. It is time to buy. It is time to wait. And some time frame will be telling you it is time not to do anything. So it is time frame that decides the kind of trader you will become, the time frame you want to use. If you are going to be a position trader, you can't be coming to 1 minute, 5 minutes, 15 minutes. These are people who want to hold trade for a long time. And exactly. Yes. So you will see them more using the higher time frame for the analysis. But somebody who wants to go in and out, in and out, in and out of the market, you will see the person around the lower time frame. Because the lower time frame is giving him the market direction for short-term market bias. Are we getting it now? But then, let's wrap it up on this. When it comes to time frame, the lower the time frame, the more the noise. Yes, the more the noise in the market that you see. The higher the time frame, the higher the clarity. The higher the time frame, the higher the clarity. Do we get that now? So, do we get that? The higher the time frame, the better the clarity. The lower the time frame, the more of noise. Yes, a lot of fake moves, deceptive moves in the market in a lower time frame. Do we get that? So we'll get more understanding as we go on. So that is that on the style of trading and then time frame. Intraday trading.
Which of the time frame? I remember the last time.
Yes.
I think we're using 4 hours.
Yes. The best time frame for a scalper and intraday trader. Now you have to do what they call proper top-down analysis, which has to start from a higher time frame, and then you narrow it down to the lower time frame for execution. So for a day trader, you should start from the daily time frame. You are not doing anything there. You just want to see. You just want to see the naked chart, what has happened, what has been happening recently. You just want to see what has been happening recently. And then you come to 4 hours, you now start using all the tools, looking out for your key areas, key levels, then putting all your instruments, and then you wait for entry at a lower time frame, confirmation and entry at a lower time frame. And for somebody who is scalping, you may not see them going to 4 hours. Yeah, you see them around 1 hour, 30 minutes, and then they go to lower time frames such as 1 minute, 5 minutes. Yeah, for their execution. 1 minute, 5 minutes for their execution. So I scalp, and I scalp a lot. So you will always see me on 5 minutes. Always on 5 minutes. But if I want to decide to trade longer for that day, okay, maybe I can now begin to look at 15 minutes for execution. I'll go into 4 hours to see a clearer picture of what the market is doing. And then I come to time frame like 15 minutes, 30 minutes for entry. But when I'm there to pick whatever is on the table, I go to 5 minutes, 1 minute. Going in and out, going in and out, going in and out. So the style you will adopt will now depend on your personality. Then your intention. Why are you trading? What do you want to achieve? Are you trading as a full-time, or you just want to use it to support whatever you are doing? That will now inform the kind of trader you will become. So for somebody like me, that my daily bread is from there, so I have to be everything there. Yeah, we do all of them together. But they all have advantages and disadvantages. All of them. Yes, all of them. If you are scalping, you will likely not see the market well.
Intelligent.
Yes.
You are careful. I lose.
Yes. Because there will be a lot of noise, fake moves. And at the same time, it can be also very juicy. Yeah, before you know it, you've made you've covered a lot of ground. So let's move on. Let's move on. Now let's go to market movement. Market movement. There are basically two movements in the market. Upward movement, then downward movement. Basically two. So it is either the price of that asset you are looking at is going up or is going down. So we call it trend. That's the language we use for it in trading. We call it trend. So we have what we call uptrend, downtrend. Then in a more technical term, we call it bullish and then bearish. What do we mean by bullish? When the price is increasing and there is an uptrend. The price of an asset is going up, is moving up. We say the market is bullish. Gold has been bullish for months now. That means it has been going up. The price has been increasing. Then when we say bearish, what do we mean? The price of that asset is decreasing, is falling, is collapsing. That means it is in a downtrend. And remember, yesterday I told us that Forex is two ways, two-way trade. You can make money while buying, you can make money while the price is collapsing, you can be making money. While the price is going up, you can be making money. So when the market is neither moving upward or moving downward, that's where we call it a consolidation. Consolidation. Say market is consolidating. Consolidating. Market is ranging. Or it is choppy. It is consolidating, it is ranging, or it is choppy. Are we following now? Okay, we can't put this one on 1 hour. It's on 15 minutes. Don't worry. So, how do we approach then? What is the importance of this market movement? How does this concern us? Now, how this concerns us is that when price is moving upward, when the market is bullish, we are looking for a buying opportunity. When price is bullish, when market is going up, we are looking for a buying opportunity. So also, when market is bearish, when price is collapsing, when price is going downward, we are looking for a selling opportunity. The trend should be your friend comes from. The trend should be your friend. The trend should be your friend. And what does it mean? What does it mean? It means that when the trend of the assets that you want to trade, if the trend is upward, just follow it up. Don't go against the wave. Don't go against the trend. That's what it means. If the trend is downward, follow it down. Don't go against it. This rule is a golden rule in trading. It's a golden rule. Let me use a very practical illustration, and not just that we can relate it with our. Now, look at what you are seeing on the screen here now. This is how it looked like. All right? Price is going up. The trend is an uptrend. So what it means is that for you, when price is going up, you have to also follow it up. When the price is going down and collapsing, you have to become the friend of the trend. You have to follow it down. An attempt to go against the trend is suicide. It's suicidal. And the reason is this. than it does when it is pulling back, when it is retracing or correcting. So there are different language we use there. We say the market is pulling back, it's retracing. It will do more movement upward if it is in an uptrend. So if you are going to sell, then that's dangerous, because you are looking for movement that is big. Do you understand that? So also, if it is trending downward, it will be doing that big move downward. Big move. Price will shift radically in that direction, and then it will do a little pullback to continue. Yes, when it's in a downtrend, price will keep going down. That we'll get there. We'll get there. When it is bullish, you are looking for a buy because you want to follow the trend up. When it is collapsing and it is bearish, you are looking for a sell because you want to follow it down. Going against that move is suicidal.
This what they're saying, that when it's a bullish, they are not expected to say you want to
look for a sell. Yes.
Looking for a sell is that you are going against.
Exactly. So I know the question you are asking, but we'll get there. The question is, okay, if it is going up and I want to look for a buy, where am I supposed to enter? Because am I going to buy? Because when the price is going up, it's not when I should buy now, it's when I should sell. I get that understanding, but this is how trading works. So you have to pay attention and follow it. Now, the rule is that you buy when price is low. You buy when price is low. You sell when price is high. So don't let this confuse you with the trend. Don't let this confuse you with trend. So the first thing is understand that you have to follow the direction of the trend. However, while you are following the direction of the trend, you need to know when to join that trend. Are we following now? This is an uptrend. So the question is, when do you come in? Because you need to join it to go up. Never come down. Never come down. So now the rule is buy when price is low. Now, in an uptrend, there's what we call higher high and higher low. Take notes. Yes, higher high, higher low. So you need to write this one down. Okay. There's what we call higher high and higher low in a bullish trend. So when the price swings up, when there's that impulsive movement upward, we call that the peak of that movement, higher high. Then when it begins to retrace, as if you want to go down, we call it higher low. Then it peaks again, higher high, higher low, higher high, higher low, higher high, higher low, and on and on and on like that. In fact, that is when this bullish trend is validated. As long as price continues to obey this structure of higher high and higher low, bullish trend remains valid. Do we understand that explanation? As long as market continues to do a higher high, higher low, higher high, higher low, higher high, higher low, a bullish trend remains valid. An uptrend remains valid. In an uptrend, we call it bullish, a bullish market structure or bullish market profile. As long as the price continues to do a higher high, a higher low, a higher high, higher low, it makes that trend to be valid as an uptrend market structure. Is that explanation clear? So, how do we know that that structure is no longer valid? It will disobey this rule of higher high, higher low in a bullish market structure. It will disobey it. That means a time will now come when the market will begin to disobey this structure. So instead of doing higher high, higher low, higher high, higher low, higher high, higher low, you know, after a higher low, the next thing is what? Higher high. The high that is supposed to form to go up more than the former high. Are you following now? Yes. It will not get there. It will not get to that level. Rather, it might get halfway or midway and then comes down. Now, it will also do something too. It will violate the higher low. Notice something here. Note something. The current higher high is always higher than the previous higher high. And the current higher low is not lower than the previous higher low. So at best, it will do what we call equal low. It will do equal at best. And this is when there is manipulation in the markets. Ideally, the new high that is formed, higher low, higher high, when it is doing higher low, the rule is that the low must not be lower than the previous low. Then the new high must be higher than the previous high. As long as it keeps doing this, the market structure is valid as a bullish market structure. And when you see such structure, what you are looking for is a buy. A buy in a bullish market structure. Do we understand that to that point? It's getting interesting. So, but the moment the price begins to misbehave, and then it's not obeying that structure, this is supposed to rise higher than this high. Then it went up a little and then suddenly came down. And also, it violated this higher low. You know, the low is not supposed to be, the current low should not be lower than the previous low. Then it goes lower. Market has changed direction. They call it change of character. You can also call it change of structure. The structure has changed. It's no longer valid. So at that period, when you see something like this, you don't trade. Because it has violated the bullish market sentiment. You wait for further confirmation, because it could still also be, it could still go higher, but that at that point, there's something going on with markets around that area that should not involve you. Yes. But sometimes emotion, they make us enter. Yes, it means that something is happening around that area that you need to wait for further confirmation. You have to allow the market to talk to you based on this structure. This structure doesn't fail, it doesn't change. Yes. So you need to understand this aspect of trading. Very important. So now, before we go to bearish market structure, it's the same thing, but in the opposite direction. Now, we said you buy when price is what? When price is low. So now, I want to join the bullish market trend. I'm looking for a buy, because when market is bullish, I should be looking for a buy. So where should I buy? I will be looking for a buy around the higher low. So you don't buy at higher high. You don't buy at higher high. You don't buy at higher high. You don't buy when price has left that zone, that area of opportunity. Well, if it has left, wait for the next one. Yes. That's where we used to have problem. That's why I said in lower time frame, there will be a lot of noise. This thing is more clearer. You see it more clearly in higher time frame. When it's doing this structure, these swings in higher time frame is more legit. It's more reliable than on a lower time frame. So now on a 5 minutes, it started a higher high, higher low. Then he now did something. He did equal high on 5 minutes. Gospel, please show me 5 minutes. He did equal high. Yet, currently now, the low is not yet lower than the previous low. But it did equal high. The high was supposed to be higher. So at this point, we are supposed to wait. Okay, somebody want to scalp. All right, he's looking for short-term trade that is going to enter from. Now he sees this moves and it's looking, okay, I'm seeing this move. What should I do? Okay, let me look for a short buy. Okay, when he sees this move here, he'll be saying, okay, around this area, around this key area, I will enter. Then boom, he entered. Market goes up. Breaks the previous high. Make profit here. Now market is going down. He's saying I'm going to buy around this area. But while he bought here, market is supposed to go higher than this. But now he did equal high. And now it's coming down. And so now, right now, the best thing to do is to wait. Because if you go to higher time frame will tell you it is not yet time to sell gold. Go to higher time frame, like 1 hour, 4 hours. It is not yet time to sell gold. Since January 19th, gold has been strongly bullish. Higher high, higher low, higher high, higher low, higher high, higher low. Now it's doing something that looks like equal high here. It's forming a resistance here. So some people can say, oh, let's sell. Don't sell yet. Let's sell. Okay, let's sell. Short-term sell. Let's sell here.
That bearish will still continue down. Possibly. And take another
up. Why? Because this is a very strong bullish momentum. So any sell you see is just correction. They call it correction. And that is the normal behavior of markets. If it moves in one direction, it must pull back to accommodate new participants. Yes, because if it moves upward, you are not supposed to buy at this point. You are not supposed to buy. So you should wait for it to pull back so that it can accommodate you. Yes.
It's this same rule.
It's the same rule in the opposite direction.
But at that, maybe when we get to the lower low, and then equal low.
Yes. Yes. However, scalpers now around this area will now be struggling because we want to trade. Because if we go to 5 minutes now, you'll be seeing a lot of activities happening here. For example, now this morning I've been stopped out here severally. So right now I'm just on the bench line. I'm watching, yes. I'm watching. Even if it sells, it's not advisable to sell because of the prevailing trend. Allow it to correct. So let's come and look for our buy again around this area. So tomorrow we'll be talking about key levels where you need to look for your entries. My next entry for a buy will be somewhere here. Yeah, where to put the money. If it fails, then I'm coming to this area. Tomorrow I will tell us how I'm arriving at such level. Just let me mark from here. Use a rectangle from here to here. With this. Let me see. Does it align with the aha? Yeah, that's a very strong key. A very strong key areas to wait for trade. And do you know what? Later in the days coming, price is still come there. It might not be today, it might not be this week, it might not be next week. Price will still come here and still obey what is here, what it has left here. Let me mark this area too. Let it join with this rejection, this aha. Yeah. So right now, I'll be waiting for what will happen. I'm waiting for either price to come here, then I pick the buy. Yeah, price will come down. And then I will buy. If it stop me out, I'm coming here to take it back. Then if it doesn't do any of these two, let me mark the resistance up. If it doesn't do any of these two, I will wait for it to break above this high. It will break it. Let me break and retest. I will wait for price to break it and then retest it. Then take it higher. Aha. This would be my entry. So why that retest? All right. Why that retest? That is higher low. Because when it breaks it, it forms higher high. And the rule is don't buy at higher high. But in Bami ojukokuru, nije ka jeko, nije ka gbono, atuma rowo. Yes, higher low. It most likely to come
back to the high indication.
This one. This resistance, once it break it, it becomes we'll get there tomorrow. Once it break that resistance, there's what we call resistance and support, supply and demand. So once it break that high, it will do a retest. It will come back and then from there bounce up. So these are possible entries for entry. So when you saw 800%, you know, you moved from 500 to 1,000 this morning. 800% as of last night. So these are how I trade. I'm always looking for areas of rejection, areas where, yeah, this is gold. Key areas of where activities are taking place. Now gold money deal. Even me, I dream about them. 2 years ago, I was sleeping. I dreamt that gold, I was trading gold in the dream and it was bringing money. In fact, that was when I started forgetting about other assets. So that is how we treat the trend. You make the trend your friend. So in this trend now, you just keep looking for buy. Keep looking for buy. Just buy. But when the market is collapsing, you'll be looking for sell. Sell. So you will now begin to look for those key areas, key level areas. So tomorrow we'll now focus on how to mark the key level areas of entry. Key levels. So now let's go. Do we understand it to this level? So the bearish trend is just the opposite. It's just the opposite. So when you begin to study trading and then maybe you are studying yourself, you will be stumbling on some terms, on some technical terms. Don't trouble yourself. Everybody is saying the same thing. Yes. It's only terms and language that is different. Some make their own to be very sweet to the hearing. You look like, oh, this one, na dear money day. They will use institutional languages, banking terms, heavy terminologies. Forget about those things. Everybody is doing the same thing and saying the same thing. So I'm not going to bother you with all of those things. Like order block, fair value gap, mitigation. Forget those things. There's nothing mitigating anything. It's the money to enter. Yeah, it's for the money that people have been mitigating for years. The mitigation has not brought the money. Liquidity grab. What is another one? Liquidity sweep. Many times is all the same thing. So when you are watching, you are studying online, which I will encourage you to do, and you are hearing those things, don't say, this man didn't teach us this one. It's the same thing. It's the same thing. What is more important is that you go there, you make the money. You go there, you get it. So in the bearish trend, it's the same thing. Market is falling. In this case, it's doing lower high, lower low, lower high, lower low, lower high, lower low. So as long as this structure is obeyed, a lower high, lower low, lower high, lower low, the bearish trend, the downward trend is valid. Valid. As long as you keep doing it, you can point where price peaked, and then you could see the swing, the impulsive movement, and you see it repeating itself, repeating itself. By the way, let me quickly digress a little. Markets will always do the following: expansion is called market cycle. Retracement, reversal, then consolidation. Market will always do this. It's a cycle. It will expand, it will retrace, it will expand again, it will reverse, it will consolidate, it will expand. Expansion is a sharp movement away from consolidation. A sharp movement, like this is an expansion. A sharp movement away from consolidation. This is a consolidation. Then this movement is an expansion. Then this is a retracement. Then another expansion occurs. This is a reversal. A reversal is a return back to where it expanded from. Then it consolidates. Then expand, retrace, expand, retrace, expand. So when you see that higher high, higher low, higher high, higher low, it is an expansion and a retracement. Expansion, retracement, or expansion and consolidation. So consolidation is when markets is neither moving up nor moving down. Yes, it's ranging, maintaining a particular high and a particular low. It's being trapped. It's like this is a trap here now. This is that consolidation here. You can't really say it's going up or going down. Yeah, it's the same thing. You see it? And that is where traders burn a lot of money. Yes, during consolidation. That's where money go missing. It's not going up, it's not going down. So you will see that the markets will be trapped. Two things. If you are an experienced trader, you'll be trading between the two, the high and the low. When you get to that low where it is bouncing from, you buy. When you get to that high where it's bouncing from, you sell. When you get there again, you buy. Experienced traders. Even we see they make mistake. Yes. In fact, most of my bad trades comes from when markets has consolidated, but I am not fully aware. I have been psychologically trapped. So that's why sometimes you have to take a break and look at the market from a neutral perspective. Neutral perspective means you are not trading, you just want to see what is happening. Because you will be carried away with the impulsive movements. When it consolidates, you will not know. So the moment it take you out the first time, the second time, the third time, just bakamu it consolidate. So step back a little and wait. So we will now be waiting for an expansion. So once it expands, we will now wait for a retracement and then enter from there. Because when it expands, don't buy there. Don't buy at higher high. Don't sell at lower low. You buy at higher low. You buy at higher low. You sell at lower high. So let's come back to our. Are we following now? Is it getting interesting? Sir? Yeah. Yes. Okay, you need me to still make more. Now, expansion, like I said, expansion is a sharp movement away from consolidation. When you see a sharp movement, an impulsive move, a very strong one, that's an expansion where you will see big candlesticks. You see, price is just doing this, then suddenly, this an expansion. Either up or down. Yes, a long move. It could be 2 candlesticks, it could be 3 candlesticks, but massive ones. That's expansion, a sharp movement away from this area. Then, after expansion, either of the following can happen. Hey, wow, see this drop, and I was anticipating it to. Try. I don't miss them. Wait for another opportunity. So, either of the following could happen. There could be a reversal such that price returns back here. The same way it went up, the same way it will collapse back. That's reversal. A return back to consolidation where it expanded from. Yes, I will explain it. Yes, I will explain it. Now, I said it could do any of the following: a reversal or a retracement. A retracement will be a short pullback to continue the expansion. Yes, it could be 20%, it could be 30%, it could be 50%, it could be 60%. who made that impulsive, the previous impulsive movement. Is either they are taking profit, or new order is being gathered to take the next flight. So let's start rounding off. Where is that? Gospel, please put it back. Put it back. Gold is rushing down. So let me show them that this chart I was showing our area of interest. Okay, so you see now, let's assume that because we say buy when in the bullish, you now want to buy here. Look at what the price is doing. And it's likely that it comes here. Likely. It doesn't cost gold anything to be here. It's just about 600 moves, 600 pips move, 700 pips move for you to get here. Gold can do it in less than an hour. Though this is another area of interest too. Gospel market. No, not this one. That's another area of interest. No, what you are going to do here is you are waiting. So now when it gets to that place, gospel just marked now, I will now be waiting for a reaction. Candlestick reaction. We will talk about that tomorrow. So because it cannot just come here and I enter. I need to wait for some confirmation. It could still form more. So when it gets here, it will pause. Most likely. Price will pause. It won't just collapse. When it gets around this area, it will begin to struggle. Either to go back up or to fall down the more. So me, I'm just waiting for some confirmation. I'll be waiting for what I was mentioning that time. Either liquidity grab, which one again? Give me the name now. If it is not liquidity grab, it is what? Liquidity sweep. Yeah. I'll be waiting for the reaction around this area. I want price to come here and then face up. To pick a risk. Anyway, like I said, trading is 50-50. 50-50. If you enter here, it can either go up or go down. However, what increases your opportunity is when you are trading according to plan. Normally, trading is 50-50. If you buy, you can buy or sell. That's why somebody learn trading today can make money today. It's 50-50. That's why it's not gamble. Gamble, the person who decide the gamble has a higher opportunity than you. It can't be 50-50. It's always 75-25. But it is 50-50. So if you buy here, you can buy, you can sell. But as a trader, you don't buy there. It's called a no man's zone. Yeah, it's a territory where nothing is sure. So you gotta be waiting for trade where something can come out from. Yeah, this is live. Yeah, this is what is happening live right now. Yeah, of course, we will be looking. We are here together. Because me too, I'm interested. We are here together. So now, like I said, I'll be waiting for price to come to this area. And I'm waiting for some reactions. No, the reason is because there are certain parameters to look out for before you execute a trade. there are certain parameters you have to look out for. You have to, that's why it's called technical analysis. It's more scientific. You are looking at activities that have happened before. And they always say history repeats itself. So you are looking at activity that happened before. You are looking at where did that activity happen before. So it is likely that at that area, what happened before can still happen again, or will still happen again, and the chances are higher. So what?
Look at
Okay, by this one candlestick, and you can't conclude yet because this is just one candlestick. It has to form more candlestick, but it's still dangerous. We'll learn that tomorrow. It's still very dangerous to enter a buy. So what you can do now is that you either wait for what is going to happen here. Yes, at that resistance. And you have to be very careful because it got here, rejected, got there again, rejected. There's a likely chance that if it gets there the third time, it will reject again. So you have to trade within the zones. Your trading area is here, here, and why here? Because of what happened here. Then here, this area, because price was getting here to this area and was rejecting. It got here and bounced. It got here and bounced. So whenever price gets here, there is a higher chance that it will bounce. Now, what I'm showing you now is just like saying, how do we know rain is going to fall? Because of weather. The cloud will be forming. That's how I usually illustrate this thing to people. And from history, whenever we see such sign, the higher chance that rain will fall is high. The same thing here. When we see those signs, the higher chance that it will repeat the same thing is higher. It may not, because not all cloud will eventually turn to rain. Sometimes it will shift. But the probability is 75-80. Yes. So right now, there is nothing to do. As a matter of fact, going by what is going on here, it has formed what we call, in this 5-minute time frame, it has formed what we call double top. This and this. And it broke the neck already. So it's not advisable to go in there at all. Not even for a sell, actually, because in higher time frame is a bullish trend. If I am going to sell, I have to wait for it to come to this area. If at all, and that sell is not a secured one. Because when market is in a particular trend, it can suddenly pick up that trend again and start moving. This is the first time we are doing this now. No, it's also his first time. Everybody here. Yes, that's analysis. That's technical analysis. You are using previous charts to determine what will happen today. Because this thing is just happening. It has never happened before. So what is informing my decision, what I am going to do, is based on what has happened before.
The market buying and selling.
Yes, sir. 100. No, they are not the one drawing it. Oh.
Yes.
The psychology that is taking place in the market space, negotiation, transactions, economic situation, weather, news, panic, rumor. These are the things that is determining what we are seeing here. Everything happening in the marketplace. If Trump cough now, right now, I'm telling you, you will see it here. Yeah, yes, sir. That's why we have been seeing some crazy moves in the market. Everything is reflected here. Yes. Yes. That's what we are. So it's not that somebody is designing this thing. Nobody is designing it. It is an expression of human hope, fear, greed, anticipations, including rumor, news that are not true, affect the markets. Somebody can just come now and say, maybe so the person has influence, and enter the market. For example, you can enter physical gold market and give an information that the king of Dubai is saying that from next year, they are not going to be buying gold from Sudan again. Fear enters the market. Exact, and it start affecting market because people at that moment, there's panic. Either people are buying and selling unnecessarily. You start seeing it reacting, and you not be wondering why is there this unexplained move in the market. Yeah, this is it. That's what is affecting the market. So now, as a technical trader, because you may not have access to those information, all of it all. That's why you rely solely on the charts. This chart you are seeing here, that's why you rely on it. And what you are doing is that you are using the previous occurrence to determine, to predict what could happen today. And it has always been like that, and it has always worked. It has always worked. All the time. Most of the time. As simple as drawing a trend line is, which we will learn tomorrow, as simple as drawing a trend line is, you will be surprised that when you draw a trend line, when price is coming to that area, you will see price touching that trend line and then going up again. You will not be wondering why. Is because you see that trend line you are seeing. Retailers are the one waiting. So most people are waiting for price to come there and then to trade. So because a lot of traffic are at the same area waiting to transact, it will respond. So it is not the trend line that makes it respond. It is the psychology of people. Because most people are waiting for price to react at that area. Like let's say we have 500,000 traders. Out of those 500,000, 300,000 anticipate that once price gets to that place, we have to buy or sell. And the moment price gets there, you will see it reacting. Because people are loading the market with money. And as they are loading it with money, it begins to move. Institutional traders don't use trend line. They have what they call institutional flow. They have where they gather their orders. They have what they call order blocks. Retailers use trend line, and they still respect them. Institutional traders use order block, he still respects them. where the either of the sides make money is that when the volume, when the liquidity in the market falls to the retail side, that means they have more money. The institutional traders start losing money. The truth of the matter is that what yes, now it's possible. Of course, it's possible, but most of the time they have more money. They are few, but they have more money. So institutional traders too, they lose money, but in the long run they make more money because they are not scalpers; they are position traders. So that place where you are making $10, $20, $100, even $10,000, even $100,000, it doesn't shake them. It doesn't shake them. These guys are putting in billions into the something, and it take them days to fill up an order. Yeah, it take them, for example, if they are going to load buy on this gold now, the way they do it, and let's say an investor gave a hedge fund, let's say $10 million. If they want to load buy here now, around this area, they are always looking for a price. So if price does not come to that place, they will not put the money, and they cannot put all the money at once because price will move. So the moment price gets to that 5,080, they quickly put 500,000. Once price move away, they leave it. Once price get there, they put it again. If price go lower, they wait. Once price goes there, they put it again until they successfully load, and it can take them weeks. But your 100,000 is once. In fact, your 100,000, you still collect leverage on top. Broker will still give you leverage. So that's how the market operates. So now, while they are loading that money, there could be some mistakes they will make because they may not be getting it perfectly. So during that period, you are making money, they are losing part of that money, but they don't feel it because they've not finished loading the system. Maybe by the time they finish loading it, they will now have a lot of money, and they may not be the only one. They call themselves, those banks, they call themselves, we are loading dollar at so price. So everybody's loading. The moment they finish loading it, their money becomes more than the retailers. Price goes in their direction. And they use 1 billion to take 300 million. So the truth of the matter is that while you are selling, somebody's buying. While you are making money, somebody's losing money. Yes. Yes, that's it. Yes, that's how it is. Somebody's losing money somewhere. No, it's not rolling like that too. It's not circling like that too. Because some people are actually making the money and not returning the money. Yes, those who know how to handle it, they are making the money and not returning it. Yes. So this is where we are going to end it for today. So tomorrow we will now go more deeper into tech. I hope today's own went in. So final question so that we can close from tomorrow. So tomorrow we will now go into some technical analysis, how to mark your key areas, how to know when to trade, when to execute, and so on, like trend lines. We might not even to go through trend line. Trend line is too elementary. It's just to mark your key zones. If you can look at the chart, you should be able to know key zones. If you can look at the chart, you should be able to know what the market is saying. It's just to mark the key zones. Trend line is very elementary. Any question? Hope you are not thinking of turning back. it's like it's like a course you are studying in their institution. Yes. I know somebody, not that I know. I had the story of someone when I was in UAE. This guy spent 4 years. I also watched his YouTube video. He said he spent 4 years at home. He refused to go to university. He said that 4 years I will go and spend in university. I will spend it learning this thing. So he did 4 years schooling himself on trading. No, the guy he's doing crazy things. Now he's from Pakistan. He's doing crazy things now. He's doing crazy things right now. He spent 4 years learning it. Started from the scratch, follow it step by step. And he said from the video, he was so diligent that he was doing it as if he was attending university normal for 4 years. He said those who are going to university, at the end of the day, what is the end? Is to go and look for job. And it's so funny that if you have the money, you employ those that went there.
Not even until recent anyway. Before now, we discovered that most schools in maybe Lagos, who didn't go to university that owns those schools.
Yes, sir.
And then everywhere you come back from.
It's from school. Money is powerful. God will give it to us in plenty. Thank you so much, Sas. Yeah, thank you. Yes, sir. We are going deeper in technical analysis. No need. From tomorrow you get an assignment. Yeah, so tomorrow when you come after the class, you do assignments. I will give assignment. I will tell you to go and look for certain things. Yes. Then by Thursday, we'll do demo trading, all of us. So we'll be looking at the market and then trying to see what can happen. Thank you so much. I'm very grateful. Gospel, we are done.